Welcome to the week ahead for the week starting Monday, the 9th of June. Certainly, we're leaving behind a week that had a big focus on the jobs, but the week ahead is going to be focused mainly around inflation coming out of both the US and China. We'll also see some jobs data coming out of the UK. So let's look into the outlook for the three main themes in the week starting Monday, the 9th of June. So first and foremost, let's look at the big ticket items according to Trading Economics. And we can see on this occasion, we're going to be kicking things off early doors on Monday. And that's with the inflation data coming out of China. That's going to be the first major event for the week. And there's an expectation it's going to worsen further down to minus 0.2 from minus 0.1. We also see trade data. So it's going to be a really interesting start to the week with a theme around China. And certainly coming off the back of a week that had a big focus on how the US economy is doing. And that certainly has the implications on how much leverage Donald Trump feels he does or doesn't have, or how the Chinese feel within trade negotiations. Similar kind of story, but this time it's the Chinese side. Then Tuesday, we've got the jobs report out of the UK, the Westpac consumer confidence change out of Australia. We've got inflation data on Wednesday. That's the big theme in the US. And then the back end of the week, GDP and a host of UK data points on Thursday morning, and then PPI inflation out of the US on Thursday, rounding things up with the Michigan Consumer Sentiment Survey. Make sure to look out for the inflation expectations metrics within that report as well. So let's kick off with the US, probably by and large the most likely events that people are going to be trading around, in particular the inflation report coming out on Wednesday. Now, we leave behind a week where we saw, I would say, mixed data, but by and large, it was negative. Look, I'm recording this prior to the payrolls report, but certainly leading into that, we saw weakness in terms of the ISM manufacturing, ISM services, and the ADP payrolls. We saw a little bit of sort of better than expected numbers from, say, the JOLTS numbers and things like that, but certainly the big ticket items up until Friday's jobs report have come out better than expected. The question mark here is, are any of these data points going to force the hand of the Federal Reserve? And the short answer is that it could do, but probably not now. And that's because essentially the Federal Reserve are going to sit on their hands until they know exactly what's happening in terms of tariffs, exactly what's happening in terms of the bill and the debt. And therefore they have a level playing field within to make decisions. At the moment, it's a guessing game, and anyone trying to guess exactly what Donald Trump's doing next or going to do next in terms of trade relationships and things like that, no one has a clue. And sometimes it feels like Donald Trump doesn't know what he's going to do from one day to the next. So for him to claim that Jerome Powell is a fool essentially for not cutting rates in the face of the weakness that has by and large been created by Donald Trump's policies doesn't really stand up. So July is when we're seeing the vast majority of the reciprocal tariffs coming back into play. And so I think as we get closer to the 9th of July deadline, the closer we get without trade deals, the more likely we are that we're going to see markets roll over. On the flip side, if we start to see trade deals coming into play and therefore the risk associated with that deadline start to fade, then we can start to see markets really pricing in an increased chance that the Federal Reserve are going to act soon. So in terms of inflation, this time around, the monthly core figures expected 0.3, the headline figure 0.2. The year-on-year figures, by and large, it's a case of sort of base effects coming into play, both of them expected to rise. So if you're looking at just the headline numbers, then you might say, look, inflation's rising. But in actual fact, if we do see numbers akin to what we're looking at here, 0.3, 0.2, both relatively sort of under control, certainly not seeing runaway monthly inflation if we see figures like that. And then on the PPI and core PPI figures, a similar kind of story, 0.1 and minus 0.1. So very much under control. So what's very interesting here is, of course, we've got tariffs. We've got the sort of sector-specific tariffs in play. We've got the 10% tariffs. We've got the reciprocal tariffs. Reciprocal tariffs are off for now. The 10% are in play. The sector-specifics in play. But what you get alongside this is a great deal of uncertainty within the economy, within the workplace, within the employment market, within the sort of investment decisions of businesses. And therefore, that weakness breeds potential weakness in terms of spending activity and demand and things like that. And therefore, businesses are potentially going to drop prices or stop raising prices to the same degree. At the same time, businesses importing into the US could drop their prices and lead up to it. So to an extent, the fear surrounding the uncertainty right now is deflationary by nature, aside from the fact that the policies implemented by Donald Trump are inflationary when it comes to tariffs. So what's notable here is, do we continue to see inflation under control? And if we do, then people can not necessarily price in a rate cut, at the next meeting, but certainly price in an additional amount of easing at the second half of the year, essentially. Now, if we're looking at the sort of breakdown in terms of the trajectory of inflation, what we can see here is that, we're talking about base effects coming into play and the possibility that we see higher inflation despite monthly inflation looking like it's under control if we see the numbers come in as they're expected. And this shows exactly that, right? Because if we see in the middle section, the May figure is what we're waiting for. If you look back to the May figure of 2024, you can see 0.1 on the core metric and 0% on the headline metric. So with that being stripped out, all it takes really is an average reading of something like 0.2, which is what markets are expecting, for inflation to rise when it comes to year on year, because you're taking out a small figure, you're adding a marginally higher figure, and therefore your year on year figure rises without necessarily a very concerning figure coming into play. It's not like we're seeing 0.4 or something like that. So what we can see at the bottom here is that the 10-month annualized inflation figure is where would we stand if we get past these next 2 months? Because you can see June is a very similar story. It looks like 0.1 on the core figure and 0% again on the headline figure. So it's a similar story next month. There's a good chance that we see both metrics rise once again. And so if you just look at it on face value, you could say, look, tariffs are inflationary, they're causing inflation. That's not necessarily the case so far, because in actual fact, if we see inflation at 0.2, let's say, then that's arguably more under control than much of what we saw in the second half of 2024, if you look at these monthly figures here. So where do we stand at the point where inflation could start to either flatline or start to roll over again? And that's essentially after the next 2 readings, including the upcoming one. So it'd be take core back up to 3.15, that's currently at 2.8, and the headline number at 2.9, that's currently at 2.3. So be aware of the fact, I say the fact, be aware of the chance of inflation in terms of these year-on-year metrics for the next 2 reports. Do with that what you will, because markets might react to that. And certainly if we do see higher than expected monthly figures coming into play, then that, of course, would have a disproportionately bigger effect, because we're expecting year-on-year inflation to rise anyway, even if it just comes in at, say, 0.2. So if it comes in at 0.3, 0.4, like an actual worrying monthly figure, then we could really see markets react. And how would markets react? Well, what this would do would essentially stave off the idea that we're going to see a raft of rate cuts at the back end of the year. It would cool the anticipated rate cuts being priced in for H2, and therefore it has implications for different markets. So the market I wanted to look at today is for gold. Let me just bring up the chart for gold. There we go. So let's make me into a small head. And here we go. So this is the gold chart, and we can see from a long-term perspective, it's very bullish, right? This is the kind of market you want to be long. And ultimately, retracements and pullbacks can be long-standing, but the rallies are generally strong. The pullbacks are generally either fleeting or, if long-standing, very gradual in nature. And then you have these phases where you sort of break out from these basing patterns, and then you just see runaway strength. We've seen it in the past. This isn't necessarily extraordinary. And if you look at what we're seeing at the moment, it looks incredible. But we've seen rampant rises in the past. And certainly if you put on a logarithmic scale to sort of give it a little bit more sort of relativity, I would say, you can see that essentially we also saw very strong rampant gains, 23, 4, 5, 6, 7, 8, blah, 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 all the way up to 2011, right? So you're talking about like an 8-year run, 9-year run. Where are we at the moment? Well, if you include this move here including that, we're at sort of 2018, so 7 years, and that's considering that like half of that is us coming into prior resistance and then consolidating for a while. So I don't necessarily think that this is over, and certainly there's enough drivers when it comes to the debt, for one thing, the possibility that the central bank are going to end quantitative tightening and potentially move into a phase where they're looser with their monetary policy. All that is bullish for gold. But like I said, it depends on how this data comes out. If we see strong inflation data, if we see a monthly inflation figure of 0.3, 0.4, that year-on-year figure rises significantly, that could dampen expectations for rate cuts and dampen sentiment for gold. Conversely, if we saw a weak inflation metric, and if markets are able to look beyond the year-on-year numbers, because for the next two reports, like we've seen, that they're not going to be ideal, then that could provide another boost for gold. From the sort of chart perspective, what we can see here is we sort of consolidation, break higher, then we start moving into higher highs, higher lows. Then we move into this phase. And this phase was where we started to see stronger data coming out from the US. We started to see inflationary concerns coming into play at the same time. And therefore, markets essentially started pricing in less rate cuts. And now we're moving in the opposite directions and starting to turn higher once again. The ABC style retracement into that deep fib zone below the 61.8 to me means that this is done and that we're ultimately going to push up into record highs of 3,500. We've broken up through all the fib levels on the way up, but the next level that needs to break to give us confidence for this breakout is 34.38. Until then, we just play it on the 4-hour chart and essentially look out for the continuation of higher highs, higher lows. More recently, you can say, well, we posted this low here, and therefore, what we're seeing at the moment could be a retracement of that. We did manage to flush up through that prior high. So let's see exactly where these fibs have come into. So it came into a 38.2. We've rallied. We're sort of pulling back at the moment. If we break back below this prior swing low, or the recent one, which is 3332, then it points towards this wider retracement coming into play. But personally, I do think there's a good chance we do continue on this upward trajectory, and ultimately we continue on the vein of form that gold has been on. Interestingly enough, something worth bringing to your attention is the sharp decline that we've seen in terms of the gold to silver ratio, something I created a short video on the YouTube channel. But if you look at the long-term relationship between gold and silver, let's just hide this. There we go. So this is, we've still got our fibs. So this is the gold silver ratio. And from a historical perspective, let's see it where we've just recently topped out. It's in April. From a historical perspective, very stretched in terms of that ratio. You can see the only time spanning back over my lifetime, the only time we've seen the ratio more extended was back in 2020 with the pandemic. So that overextension appears to be over, and now we're seeing a sharp move towards the downside. So worth bearing in mind, if you're bullish gold, take a look at silver as well, because it's really catching a bid at the moment as that gold silver ratio starts to unwind for the near term. Next up, let's take a look at the likes of China. Now, of course, the week just gone was kicked off essentially with all this talk of Xi Jinping and Donald Trump. They can have a call. You start to think, well, ultimately, when they actually speak face to face, they're going to make some sort of deal, because thus far, the Chinese don't necessarily appear to be that desperate to make a deal, despite the fact that they're heavily reliant on exports into the US. In part, I think because they know the strength of their hand when it comes to rare earth materials. And there's stories of US car makers setting up hubs to create their cars, or at least part of their cars, like the electric batteries and the like, in China, right? So relocating into China out of the US, which is the complete opposite from what Donald Trump has been aiming for here. But nonetheless, that highlights the fear that if they don't have these rare earth materials and minerals, they won't be able to create their product. So essentially, it appears to be the case that China have the trump card. Excuse the pun. In terms of the data this week, we've got inflation, we've got imports, exports. And the story here is, can we see the Chinese economy in a sort of strong light, or is it floundering under the weight of tariff concerns and the like. Well, markets expectancy year-on-year inflation at minus 0.2. So that certainly doesn't point towards a booming economy and booming consumer right now over in China. If you're looking at exports, you can see last time around, the April figure, we saw 8.1. And so that points towards a lot of front loading, people trying to get ahead of those tariffs. And then we're seeing the impact of those tariffs here with a minus 4%. And so certainly if we see weakness in terms of, say, exports, if we see weakness in terms of inflation, what does that do in terms of, say, the yuan? Well, first and foremost, we can see here that negative trajectory and the downbeat inflation that we've seen in China thus far. Arguably, this has been very useful for the world because they export around the world. So they're essentially exporting disinflation or deflation at times. And if China had massive inflation at the same time as everyone else did, the inflation problem would have been a lot worse. But what's notable here is this is a new chart that I've made for this one, and it's really interesting. So these are the two periods where Donald Trump was in power, right, at the White House. From the day he stepped into the White House, what happened to the US dollar against the Chinese yuan? And what typically happens at the beginning of this period is that he comes in heavy. He comes in with tariffs. He comes in breaking relationships to try and get good deals. And what the Chinese have is the ability to set the range within which their currency operates. So if you're going to charge me a 10% tariff, for example, what's something I could do to try and mitigate that 10% levy that you've just charged on my goods? Well, I could essentially devalue my currency. And the more I devalue my currency, the less it'll be from 10%, because it might seem more expensive by 10%. But if the currency of the good you're buying is cheaper, then it means it's going to mitigate some of that. At the same time, you've seen this weakness in terms of the US dollar, concerns around the debt, concerns around relationships with the US, concerns about US exceptionalism, all plays into this US dollar theme. And certainly the longer that this trade war goes on, and in particular, the likes of China hold off and don't necessarily make a deal, I think it all points towards potential weakness for the US dollar. Now, what we've seen here in terms of the US dollar against the Chinese yuan is that in actual fact, we've seen dollar weakness and yuan strength. So that strength is counteracting what you might think that they would do in terms of the yuan. But nonetheless, by and large, it's not necessarily a long-standing move. And you can see that in the past, what we've seen here is the US dollar against the Chinese yuan then start to strengthen heavily with the yuan losing ground. But for the time being, US dollar against the Chinese yuan is playing out to the same story as we saw last time around. So let's see if we see a continuation of that. And certainly if we see the chart pointing towards an extension of the weakness that we've seen at the beginning of this second term under Trump. So this is the weekly time frame for the US dollar against the Chinese yuan. Long-term trend looks like that. We've essentially topped out at the same area time and time again. So the 737 kind of area. You can say that we're in an uptrend. If you look at the monthly time frame, you could say, oh, look, well, we're actually trending higher. Yeah, that might be the case, but we've still got quite a lot of space towards the downside, and maybe this is a topping pattern, who knows? But, you know, certainly if we're looking at that previous example, there could be plenty of time for downside of the near term. What we've got here is a very clear-cut downtrend that's playing out over sort of, I wouldn't say near term, I guess sort of medium term, depends on how you view your time frames. So there's one fib. Let's just put that into a deep fib. So yeah, that's 61.8. Get rid of the 76.4. So the next one we can see pretty much is flat, right? So we just about carved out a low high. And now we're moving towards the lows once again. That low comes in at 7161. So essentially, we have got a clear downtrend in play. We've got room to move into. I would expect to see further downside in play here. If we do see the data coming out to the point where we expect the PBOC to potentially step in, maybe that could provide some weakness for the yuan. But certainly, I would say play the trend, and certainly from a historical perspective, it's a good chance we could see further downside, particularly if we see a breakdown through 7161 here for the US dollar against the Chinese yuan. And finally, let's look at the UK. And the UK, we have a raft of data points coming out on Tuesday and then Thursday. So Tuesday, we've got unemployment, average hourly earnings, employment change, and then with Thursday we've got the monthly GDP, we've got trade balance, industrial production, manufacturing production. So plenty to look at. I don't necessarily have the forecast here, but quite frankly, even if I look at the forecast on a Friday, there's a good chance that by the time we start the new week, sometimes they change anyway. So it will be a case of looking at your calendar close to the event to see exactly what markets are expecting. But nonetheless, you know, what we have seen recently is a resurgence in terms of inflation. There's a number of factors why we saw inflation ticking higher, a lot of which come down to policies from the government and a shift in terms of the price cap for energy. But nonetheless, inflation looks like it's resurfacing. Earnings, if you look at the orange line, have sort of ticked up and then they sort of flatlined and now started to turn lower a little bit. So we're seeing real earnings starting to roll over a little. And notably, in terms of expectations of what the Bank of England is going to do, markets aren't expecting much. And part of that is because of where inflation is at the moment. And part of that is the case of actually some of the data has been all right for the UK recently, frankly, the retail sales, the GDP, the monthly GDP figure. So if we see more of that, then again, we're expecting to see that expectations for the Bank of England remain pretty cautious. If we start to see weakness in terms of the data, so let's see, last time around, I think it was 0.2 on the month of April for GDP. So we start seeing these kind of things sort of rolling over in a meaningful manner, then perhaps it starts to push expectations for the Bank of England. Currently, markets are pricing no change in June and potentially a change in August, just a 57% chance. So a coin toss for August. September, by and large, looks like it's a lot closer or a lot more likely, but really November, 85% chance. So really, markets are only expecting one rate cut, potentially two by the end of the year. You've got a sort of coin toss for a second by year end. So one or two, and then if we see some weak data, then it points towards a potential second one later on in the year. But what's notable at the moment is that if you look at the relationship between data and US markets in particular, economic data that comes in weak isn't necessarily good for markets. It's not always a case of bad news is good news and good news is bad news because of the way that it impacts the Federal Reserve's thinking. Instead, we've seen bad news as bad news because people are fearful of a recession. Whether that's going to be holding within the UK remains to be seen, because, of course, it's a bit of a different situation because the US has got itself in a bit of a pickle over tariffs. But certainly, you know, if we look at, say, the FTSE 100, what's notable here is, you know, it's gained to such a degree that people are going to be looking at it and thinking, you know, this is at risk of potentially rolling over. We've sort of come all the way up near enough to the prior high in the year. As we can see here, just 1% off that record, not record high. Is that record high? Are we? Yeah, record high. So we're not far off it, and we're losing a little bit of steam at the moment. It looks like we are sort of grinding higher, sort of recently, not really going very far beyond this resistance level of 88.12. So if we do start to break down through sort of trend line support, let's see if I can clip as many as I can. There you go. So does that extend back here somewhere? Not really. Not especially. So what you've got here is sort of trend line support, which highlights sort of gradual move towards the upside. The hourly time frame can probably see those swing lows a little bit better. So this is the latest pullback. We're looking at sort of where are your swing lows on the way down here. So the nearest one would be 87.31. We've of course got the warning sign, which will come with that ascending trend line with the breakdown. So if we break down through 87.31, then it points towards this potentially giving back some of the gains that we have seen recently. We've seen a very nice V-shaped recovery, as we've seen across many of these markets recently. But certainly keep an eye out for this jobs data. Look out for the average hourly earnings. We want to see wages under control. We don't want to see them resurface and provide fresh inflation fears. Yes, we've got high inflation at the moment and it's holding back the Bank of England, but there's question marks because of the fact that some of those effects are, a short-term adjustment in terms of policy. So look out for whether we can break either out through resistance and into a new high at 89.15 or down through that support level that we have down here, 87.31. And until then, check out this ascending trend line, which appears to be holding up once again as we grind higher for the FTSE 100. That's it for today. Hope it's been useful. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a good day and a good weekend and a good week ahead.